historically, if you look at the old, maybe 15, 20 years ago, I think rates and EM and the dollar would have been the most fundamental issue that you had to worry about, because these countries were generally all funding themselves constantly with large current account deficits and needed access to capital all the time. And whenever rates went up, they would basically struggle. And whenever rates were good, they would get inflows of money that would create dynamics. I think that there's no question that there's still a correlation with the fact of, let's say, the conditions of a strong dollar, which tend to be higher yields in the US and tightening liquidity. And I think these things still are a factor for EM, not across all EM, some countries in EM more than others. But I think the degree of that correlation is lower than, let's say, it was 10, 15 years ago. So I think on aggregate, when you look at EM, the sensitivity and the vulnerability to a stronger dollar and to higher yields is lower now than it was. But it's definitely there, and it's something that you have to think about in the scheme of investing. So I think now that it looks like we're potentially moving into a reversal of the very weak dollar, the environment we've had for 18 months, I think that there's a reasonable chance that you'll have a little bit of a hiccup as a result of it. But I don't think, whereas in the 90s and part of the 20s, that could be like terminal for a country in EM and the banking sector. I don't think the case right now. There's healthier, they're more balanced, they're floating exchange rates. So I think that it's a much more, so it's a factor, but I don't think as dominant as it is.